Okay, good morning and welcome back everyone to our Tuesday morning market outlook session, the last one that we are doing here for this year before we break for the holidays. So a lot to cover with you here today before we effectively go dark here for about a week and a half before we come back. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. What we'll do is cover, as usual, our broader market update. I want to talk a little bit about where the markets are currently trading. It's a little precarious, but I want to make sure that everyone understands how we are positioning for the current market conditions. We want to cover the global markets, rates, and commodities because there are some movements that we have seen from those markets and what our expectations going forward, especially with the big stimulus package that was just passed yesterday. What sectors are currently on the move, what opportunities we see within the sector rotation, and the current economic picture that we're currently looking at, especially when we look at income and the results of how that's impacted from the stimulus here from yesterday. And then lastly, sharing with you some of our ideas before opening this up for Q&A here at the very end if we have a few minutes. Now, the primary question that I want to help investors answer, which is something that I've been talking about here for the past few weeks, is really have all the good news that we have been potentially looking for, everything from vaccine to stimulus, has that already been priced in? Because a lot of it, from my perspective, has. And the question is, where can equity markets go after all the good news is already priced in? My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you is my technical research, the economic research that I'm currently looking at, and the ideas that we have off of the back of that. So we'll start off with the S&P 500, which is in this consolidation / grinding phase that we're currently in. And the price action that we saw here yesterday at the open really reflects the jitteriness, if you will, that the market is currently in, the state that the market is in, because by all accounts, we are fairly overbought here. Markets are fairly overbought. They're not at extreme levels yet. But if you look at and we're going to take a look at some of the indicators, there's a lot of complacency right now in this market. So any type of downside risk where the UK went into lockdown yesterday, they stopped planes from flying out of the UK. The UK has seen this new type of coronavirus, and there's a lot of concerns, and markets sold off pretty heavily at the open. Now, markets did recover quite a bit of it as we passed the stimulus bill, but that, from my perspective, really reflects the jitteriness of the market, meaning risk right now are skewed a little bit more to the downside. Now, as I said before, money flow is still fairly positive here. The momentum indicators are not at extreme levels, so we can continue to see this grind for quite some time. So investors looking at this type of market and saying, where are we headed? The answer is, at the moment, you still don't want to fight the Fed. But the question is, are there downside risks? And the question is whether yesterday's move to the downside corrected any of that. From my perspective, I don't think we have. But the question is, again, how do you position for this? So from what we're doing here at OptionsPlay is we're still maintaining long exposure in the markets. We don't think that it's a good idea to go short the markets or buy protection necessarily, but we certainly want to lighten up the long exposure we currently have going into the thin holiday markets, hold fewer long positions here. Perhaps we'll have one or two short positions on stocks that you feel are weak, but largely, instead of shorting the markets, just simply paring back your long positions. When we look at QQQ, the NASDAQ 100 index, back near all-time highs again. We did manage to break back above the September highs. We broke back above, came back to retest it, and has now tested this level twice and has bounced off here. So this is still constructive here for a continuation higher here. As you can see, money flow is extremely positive. Positioning is not yet extreme yet, so we can continue to see this grind for quite some time. And even once we get into extreme levels, we can still continue to see markets remain overbought for quite some time, and valuations can remain overbought for quite some time. As long as the vaccine distribution, in my opinion, goes smoothly, we can continue to kind of grind in this particular level unless we see some more severe lockdowns go across the country, which we haven't seen yet. We've seen limited versions of lockdowns. We've seen places close, restaurants and bars, but not a severe lockdown, closing of non-essential businesses. That has not happened. So unless that happens, I think that is the risk that we see here to the downside. Now, if we look at small caps, which have absolutely lit on fire here over the past couple of months, this is really where one of the markets that have been fairly extreme. If you can see, momentum has been overbought for over a month now. Money flow is starting to weaken a bit over the past couple of weeks. This is where I do see some risk here to the downside, especially as small caps have seen this move here, severe outperformance compared to the broader markets. We may see a little bit of rotation here over the next couple of weeks or going into next year where we see some pullbacks here in small caps. And then RSP, the equal weight S&P 500 index, still fairly strong here, outperforming the S&P 500 right now. So this is also where we expect to see a little bit of rotation, but as you can see, that is also nowhere near extreme positioning. So it has more upside here for the markets. And money flow so far still remaining fairly positive here on RSP. But when we look at on balance here, the US equity markets have lost a lot of momentum here over the past week or so. But if we look at emerging markets, there's still quite a bit of strength here from emerging markets. This is really one of the markets that we expect a bit more outperformance here going into 2021 and going into next year, because the US is still battling a very large surge in the coronavirus. Unfortunately, we have vaccine distribution. We've vaccinated about 2 to 3 million people so far. That's a far cry from the 350 million, 370 million citizens that we have in this particular country. So right now, emerging markets, not needing vaccines as heavily simply because they have very few cases. Now, there are surges that are happening in places like Japan and Korea, and they're thinking about going back into more restrictive lockdowns, but they're still looking at 200, 300 cases across a country of 50, 60 million people. The need for vaccines is certainly not as urgent. So which is why we expect in the early stages of 2021, emerging markets is likely going to remain its strength here for equities as we're looking for outperformance from an equities perspective. Now, the big news this week was the fact that the stimulus bill was signed, about $900 billion, which includes $600 in immediate relief for families, $300 a week in addition federal support for unemployment. This is going to bring income levels higher again. But the one thing that I will say is that the dollar sold off in anticipation of this stimulus bill being passed. And now that the bill is actually passed, we've actually seen the dollar stabilize a bit here. So the dollar index breaking below the 92 level here, I would say back here in late November, effectively expecting a stimulus bill to be passed. We've seen the continued decline in the dollar here over the past couple of weeks as we got closer and closer to the stimulus bill. Now that the bill is passed, we've seen a bit of a consolidation here. So this is more of a buy the news, sell the buy the rumor, sell the news type trade, if you will. We've seen a lot of these over the past couple of weeks. You saw it with Tesla. So the big run up into the front running by investors going into the S&P index. Once it was added to the S&P index, the stock sold off. We're seeing in the equity markets from the stimulus bill, there was a lot of run up going into the stimulus bill. Now that the stimulus was passed, we've seen equities sell off as a result of it. This is what I was talking about in terms of good news is now all priced into the markets. And largely the markets, to some degree, is priced to perfection. Meaning, again, all the optimism already is priced into the markets. Now, there isn't a lot more good news left in this particular market. I would say the only one thing on my radar that could have a more upside for the equity markets is the January 5th Georgia runoffs. And the risk there, and right now, I don't think this is skewing this way, but if, let's say, 2 Democrats get elected in the Georgia runoffs, then we do anticipate that more stimulus will be coming down the pipeline because Democrats will have control of the House and the Senate. They would likely pass more further stimulus. That is going to likely drive equity markets higher and maybe dollar to sell off again. But right now, we don't expect that the Democrats would get those 2 seats. So that is the only last thing, in my opinion, over the next couple of weeks here that can potentially drive equity markets, or a catalyst that could drive equity markets higher. Otherwise, I think most of the good news is already priced in, and we're more likely to consolidate here for quite some time. And this is the case for equities. This is the case for fixed income. 10-year yields, we did get movement from the Fed last week, or guidance from the Fed last week, that they're not moving their bond purchases to longer dated treasuries, which allowed the treasury market to moderate, if you will. But as you can see, 20-day moving average of 10-year yields continue to grind higher here. We've seen a modest uptick in rates. I expect this to start approaching the 100 basis point level. This has been our base case the entire time, and we expect that to happen early next year. Moves above 100 basis points, I think, are going to be fairly limited, but we have seen inflation expectations start to pick up a little. That's why we've seen the movement in gold. Gold is emerging higher a little bit. We've managed to break back above this 175 level. We've been talking about this level for quite some time. It's acted as both support or resistance for multiple months now, but we've now broken above it. I do expect some modest moves here to the upside here for gold, but not extreme moves that we have seen, like the ones that we have seen here. But with the dollar continuing to weaken, with further stimulus, further monetary policy, and the Fed keeping their foot on the gas pedal at $100 billion a month, this is going to have ramifications for gold. This is going to have ramifications for Bitcoin, for oil, any type of the commodity markets, copper, industrial metals, because they're all priced in dollars. And when dollar weakens, the price of these commodities go higher. Now, the rate at which they're happening is relatively slow at the moment, but inflation expectations are starting to pick up here. So this is one it's worth taking a look at. Now, we've seen the sell-off from treasuries. We've seen investors, fixed income investors, sell lower risk fixed income products like treasuries, and they're buying higher yield fixed income products like high yield, because this is where they're seeking yield. They're seeking yield both in high yield fixed income bonds and in equities. That's why we continue to believe that equity markets will grind to the upside despite the positioning that we're seeing. There's no question about the fact that valuations are stretched. There's no question that markets are near overbought conditions, and there's an extreme level of complacency that we're taking in the markets. But the one thing that I want to continue to remind investors is that just because markets are complacent, just because markets are overbought in itself is generally not a good reason to short the markets, because markets have been complacent and they have been overbought for quite some time, and they continue to grind higher. Yes, could you have possibly made money shorting markets if you were extremely if you got extremely lucky on timing, or if you were extremely well suited at timing the markets? Yes, but those opportunities have been very short-lived, and they have been very far and few in between. It's far better, in my opinion, to be selling vol, going long the markets in selectively strong names that you like. There are some short opportunities, but they are very far and few in between. So that is how we're positioning for the markets. And as we get into more complacent markets and we get into more overbought conditions, what you want to do is you want to start lightening up your long positions. You could add 1 or 2 short positions, but you want to make sure that you monitor those very closely, because these short positions many times start to turn around very quickly. So we're seeing this across the board, right? Put call ratios have reached a new extreme level. The last time we reached this type of extreme level was in early September, where we had the tech sell-off that drove about a 10% decline here in tech stocks. This was the last extreme that we saw here. This is the 20-week put call ratio on the left. On the right-hand side is the 20-day put call ratio. So the September lows were around 50 or so, but as you can see over the past few weeks, started to reach a new extreme. So markets are at a new complacency level that we have never seen historically. This is, generally speaking, a contrarian indicator. But the one thing that we have again said is that, before the sell-off here, which happened here around September 2nd, we had reached new extreme levels for multiple months. So just because you reach an extreme level is not a good reason to short. So despite month-long extreme levels, there was only one sell-off that we got. So we've reached a new extreme. The question is, how long can we continue to reach this extreme level for before we get that next sell-off? And what's the catalyst for that next sell-off? So if you look at what sold off here on September 2nd, there wasn't a real catalyst. Nothing happened in the market, nothing happened in the news that drove this catalyst per se. It just was extreme positioning, and market makers needed to delta hedge, or gamma hedge rather, to reposition, and that caused that sell-off here. So the sell-off can materialize out of effectively thin air, which is why, as you reach these complacency levels, you just want to adjust your positioning. You don't necessarily want to short necessarily the markets per se. You can short, but it might cost you quite a bit in terms of premium to hold that short, because it can continue to grind higher for weeks, sometimes months, before you get that correction. So looking at some of the sectors here, XLF, this is the big one that has more potential here to the upside. One of the only sectors that ended up in the green here yesterday. This is due to the the stress test from Friday night that allowed banks to start issuing buybacks. Banks have effectively been locked out from buybacks for a long period of time. A lot of the major banks hold quite a bit of cash, and one way to return this cash to shareholders is by doing share buybacks. We've seen some big moves in stocks like Morgan Stanley, JPM. There are still regional banks that we think have some upside here, but XLF really forming this base here. So when you have a combination of rising interest rates, steepening rate curve, and banks can now increase buybacks, this is really where I think XLF has potential upside. And we're talking about a sector that trades at very, very cheap valuations compared to the rest of the market. So when you look at upside here going into 2021, financials is really one place that we think is worth paying attention to. But when we look at the economic picture in the backdrop of all of this, so we've talked about quite a bit of optimism from equity markets. Equity markets are effectively at all-time highs, showing a lot of optimism, a lot of forward looking into 2021, saying that markets are going to recover. And largely, we do expect the economic recovery to take hold in 2021. The first half is going to be a little shakier because, again, we're still rising in terms of number of COVID cases. But vaccine distribution is starting. It is happening so far at what we consider a relatively optimal pace. We haven't seen any major hiccups. We haven't seen any news that there are adverse reactions to the vaccine that would suggest that we would have to pull back the amount of vaccine distribution. So for those reasons, the second half of 2021 so far is shaping up to be a fairly strong one. First half, not as much, simply because we are seeing some slowdowns. The biggest slowdowns that we're continuing to see here is really in employment, especially small business employment, which largely is restaurants, bars, services type businesses that drive a good portion of our economy, have seen significant declines. We have seen multiple high frequency indicators continue to show erosion in the employment side. So weekly claims continue to rise here 2 weeks in a row. Unemployment or job gains, we've had a fairly bad month here in the month of October in terms of number month of November in terms of number of new jobs that are added. The next Friday that we're going to see the jobs report is going to be on January 8th is the next time that we're going to see the next jobs report. So that's just a little over 2.5 weeks away. So those are, that's some of the catalysts that I see that could potentially drive some downside here the next January 8th employment numbers. But if you look at the stimulus, the one good thing about stimulus is that it adds income to the economy. And ever since the last stimulus bill, personal income levels have actually been higher than prior to the pandemic. Prior to the pandemic, our income levels were around right here. As you can see, every single month, because of unemployment, because of federal stimulus, income levels have actually been higher than prior to the pandemic. So another $900 billion is going to go to add to this, but it is in the backdrop of economic picture that is slowing down. Goldman's current activity indicator, which basically takes into account a very large a number of economic indicators and combine them into one economic indicator to give us a sense for whether the economy is expanding or decelerating, we're seeing that the month of December is starting to move below. I'm sorry, the month of November has moved below zero, which means that we're going back into contraction. This has to do with the surge in COVID cases and the resulting lockdowns as a result of it, and the services business that have had to close as a result of that have had to lay off their workers. This is causing a slowdown here in the U.S. economic picture here. So the next couple of months is going to be extremely important in seeing how this balances out between the stimulus that has been passed with the employment gains or losses rather that we may see here over the next couple of months until we get COVID cases back down, and then we can reopen the services type businesses that are currently being shut down across the country. So looking at the equity markets, where do we see opportunity? Largely, we still see opportunity in most of the names that are either tech names, meaning they're generally speaking not as heavily influenced or affected by the pandemic, some healthcare names, as well as some of the consumer electronic names. This is really where, if you're looking for upside opportunity, this is where you're going to have to look. So Apple recently, one of the things is that Apple took a pretty big, I would say, sizable hit from that September sell-off here. And this is due to the fact that positioning in Apple got really extreme here. And that justified, in my opinion, the fairly long consolidation period we saw after this extreme run-up and extreme sell-off here in a short period of time. After that type of price action, we'd like to see a long period of consolidation. But over the past week or so, we've started to see the breakout here above that consolidation zone. And so our expectation here is that Apple, number one, is going to revisit this 138 high here that we saw here from a September 2nd. I've been bullish on Apple for quite some time. I've been talking about the fact that they've been moving off of Intel chips. That is going to be a game changer for the ecosystem of Apple products here. The recent announcement that they're going to get into autonomous driving by 2024. We know that they've been working on that in the background, but they've been very, very quiet about that for quite some time. But they've been working on that for 4 or 5 years now. With the combination of autonomous driving, with the combination of the work that they're trying to do on AR and potentially VR, which is something that they've also invested quite a bit in the background, and they've been hiring quite a bit of experts in this particular field for years to build up that intellectual property. The upside, in my opinion, is the breakout above 138 puts Apple substantially higher here, and we're starting to form that base for Apple to go about doing so. This is one that I'm paying attention to. Whether you're gaining exposure through Apple directly or you're gaining exposure through an index like QQQ, I think both are reasonable ways to gain this upside exposure here to this big tech play potentially out of Apple. Another one I wanted to point out, which actually came out of our members only Friday session. So again, for those of you that are joining us on our Friday morning sessions for members, we talked about AMD here last week. AMD because I've been talking about the outperformance here of AMD versus NVIDIA for a bit of time, specifically AMD over Intel. AMD and Intel have been battling it out for decades now, really. And if you think about the fact that Intel really has been by far the dominant player in this particular space, Intel has dominated the personal PC space, and they have dominated the server space or the enterprise cloud computing space. Now, AMD is starting to make some significant inroads in Intel on this front. They've been making inroads to NVIDIA on the graphics front. So this is really where AMD is starting to show some outperformance compared to both Intel and NVIDIA. NVIDIA has been trading sideways here while AMD has broken out above this $90 level here. It's come back to retest this level twice, the 21-day moving average twice. And this is, again, another opportunity that I see here for chip makers here, especially as consumer electronics continue to be the strongest segment of the market from a consumer spending perspective, as income levels are going to be supported again from the stimulus that we're currently seeing, and hopefully a little bit more supported towards the second half of 21 from economic recovery. AMD was one of the chip makers that we are most bullish on going into 2021. So that's one we're paying attention to. Another one is Google, or Alphabet rather. This is one that's, I think, perhaps not on everyone's radar per se, but what I want to say here is that we've had a pretty major breakout level here on Google at the support level. And I think this is another opportunity for a long position here. Google, the price action of Google hasn't been particularly strong, but, we're seeing this a breakout here from Google on earnings, came back to retest this level multiple times. And I think this is, from an opportunity perspective, I think a very good risk to reward ratio where you're targeting roughly 1880 to 2000 here to the upside, and your downside risk here is just about $100 to the downside. So you have about $300 to the upside, $100 to the downside on a stock like Alphabet. So if we look into 2021, you look at who dominates the internet. It's really Google, and the work that they're doing in terms of search, the work that they're doing in terms of monetizing paid advertisement through all their different platforms. Google is by far the number one, especially if you look at, the one risk that you have here to both Alphabet and Facebook is really the lawsuits that are currently happening that have bipartisan support to break up some of these names. The risk of that, in my opinion, are fairly low, and likely those are the types of court cases that take 2-3 years minimum to play out. So in the short run, the risks, in my opinion, are low, and that's why I think the risk reward ratio here for Google or Alphabet looks fairly strong. And the last one I want to talk about here is Intuitive Surgical. Healthcare name. Healthcare has been on and off in terms of being hot and cold. We do expect, especially if the Georgia runoffs go one Democrat, one Republican, and you have a split government with Biden, that's generally speaking a strong positive or a tailwind for healthcare. Intuitive Surgical, interesting setup here. You've had a multi-month, however you want to call this, a wedge formation, a mega horn formation, a triangle formation, but you've gotten a breakout here. So you have had multi-month debate, if you will, or consolidation, and you now have the breakout here to the upside. You have strong, you have positive money flow here on the breakout. Positioning is not extreme, even though you're near all-time highs. So Intuitive Surgical, another one that we're looking at from a breakout here to the upside. So with that covers what I wanted to share with you here today. Like I said, first of all, I just want to thank everyone for taking the time out here for this morning to listen to us and explain to you where our views are for the markets going into the end of the year. 2020 has been a very challenging year, but I'm really glad that we have launched so many new things in this year to help investors navigate what has been just one of the craziest years that I have ever seen in the markets. So first of all, I just want to wish everyone here at OptionsPlay, whether you're a free trial member, whether you're coming to us for the first time, or you've been supporting us as a member for years, just a very safe and happy holidays to you and your family. We could not have done this without you, and we really appreciate all of your support and allowing us to continue to do this and keep up what we started in the beginning of the pandemic, which was really just putting out research to help you navigate the markets and really taking that into the end of the year and continuing to do this and can accelerate the stuff that we're doing into 2021. We have a lot planned for you. Just starting in January of 2021, we're doing more of the rapid fire sessions that you guys have given us a lot of feedback on. We've been able to share a lot more symbols with you guys as a result of the rapid fire sessions that we've been doing. So we'll be doing 2 of those in January, and we have 2 thematic investing sessions that we're going to be doing in January. This has come out of this recent cybersecurity one that we did that gave you an overview of the industry and showed you some of the names that we wanted to play here in the cybersecurity space. That was well timed because right before the hack, and now we've seen some pretty substantial moves on some of those names. So we're really looking forward to doing this in January, where we're going to be covering renewable energy. We've been a lot of interest from electric vehicle stocks. We've had a lot of questions from investors about solar stocks. So we're going to cover both of those themes here in the month of January, break down those industries, show you the trends, and show you the companies that we are looking at for the long-term investing. So we're really balancing, a combination of helping you navigate the markets, showing you what symbols that you and us are paying attention to, and then showing you some long-term opportunities as well in the broader markets and expanding the offerings that we have here for our members. So I do want to, before we log off here, say a big thank you to our members for supporting us this year. If you have not become a member yet, like I said, a lot of things that we're going to be doing here in January will be members only. You can sign up for your membership here using this link here on your screen, which I'll post into the chat window. And if you're a first-time viewer of OptionsPlay, if you're a first-time viewer of our market outlook sessions, you can sign up for a free trial at optionsplay.com. So with that, this is our last session for the year. Again, I am wishing everyone a safe and happy holidays here. And I will see you guys here in the new year. On January 5th is going to be our next session. It'll be the same Tuesday morning market outlook session, giving you an overview as to how we're kicking off the year, and then we are going right into education. We're going right into the thematic investing with renewable energy and electric vehicles. So with that, thank you so much. I hope that you guys have a great trading day, a great holiday, and I'll see you guys here in 2 weeks' time.